Hello all and welcome back. If you have been following this channel, you may have already noticed that I really enjoy talking about financials, and I also like studying about companies and studying how the balance sheet works, the income statements work and all that. But I have a thing about explaining things in an easy to understand manner, and that actually helps me myself basically because it's one thing to actually learn about a concept, and it's another thing to be able to recall how a concept works. And in this video, I'm going to attempt to talk about the P ratio and the earnings per share, which sound weird, sound difficult as concepts. But what I'm gonna try to do here is I'm gonna try to dumb it down to a level where it will actually be easy for anybody to reconstruct. Because I myself had the problem of forgetting things like I'm thinking of EPS or earnings per share, the P ratio. And I'm like, what does that actually mean? I mean, after a while, I'm actually forgetting about it potentially, and so I'm trying to find ways, to remember things and be able to reconstruct things even if you don't remember them. And so this is what I'm going to attempt to do with this kind of series that I am creating, which is basically going to be discussing financials and economic principles in plain English. That's the way I'm naming this playlist basically. And we will start off with, as I mentioned, with the P ratio and the EPS basically. And I'm gonna try, as I said, to make it easy to follow. And so, in order to start that, let's talk a little bit about the P ratio. So let me bring up text edit actually, because I think it's gonna be easier to discuss a few things with it. So for starters, let's talk about the PE ratio. Actually, that's probably okay. I guess the size. So PE ratio. How can we construct that if we don't know what it is? So the only thing that we need to remember is that this actually means price to earnings. So basically, almost everybody remembers that, right? I mean, it's price to earnings ratio. I think I should probably make it a little bit smaller. Okay, so price to earnings ratio. Everybody can tell what price is, right? It's the price of the stock. I mean, that's simple. But earnings, what does that actually mean, and how we actually get that? Now, the earnings of the company come as part of its financials, and you can see here in the income statement that the company is actually, since it's a public company, they publicly announce how much money they make, how much money they spend, how many loans they have, what they're spending on preferred dividends or normal dividends, and all that. And so they come back with actual numbers here that you can actually use to calculate the P ratio or the EPS. And obviously, you can always find this kinds of information in like statistics. I think it's here where you can find the P and EPS, for example. But I'm going to attempt to show you how to calculate those so that you actually understand the core idea behind them. That's what I want to do with this video. It's all about understanding. And so as we're talking about earnings, so yeah, going back here to financials, you see that the default is showing the annual income statement here. I kind of like to go with a quarterly, actually, just because I have the last 4 quarters. And so what I like to do is the first thing, notice that we want to be calculating the P ratio and the EPS based on a trailing 12-month period. So it's basically the last year from now, basically, or trailing 12-month period. And so this gives us a better picture, right? Instead of actually calculating it for the last year, for instance. And so what I like to do is generate a sum of how the company did in the last 4 quarters. And what you want to be getting here is the net income applicable to sorry the net income, which comes actually after over here, a net income applicable to common shares, because you want to be uh, factoring for possible preferred stock. Now, in case you don't know, preferred stock and some other adjustments as well is basically sort of like it's considered almost like a loan to a company because it basically works like a bond. It's like a combination of a bond and a stock. We're probably going to talk about it separately. But the idea here is that this kind of expense for a company, the preferred stock expense, is actually deducted from the net income of the company. It's considered an expense, while dividends are not. And so that's why you see here that's like the preferred stock and other adjustments here. So in case these were the company has actually paid preferred stock, this would have been reflected here. And so let's open up our calculator here, and let's actually do the math. So 11,519 plus. So basically what I'm doing is I am adding all the quarters. Simple enough. So 4 quarters, 65 plus 10.714. So this gives us 56.12, which is, in case you don't know, this is in millions of dollars. This is in thousands, basically. So this is actually 11 billion here, 13 billion, because it's in thousands. So it's 11,000 millions, basically. So it's 11 billion. And you can actually see that here all numbers are in thousands. And so now we know that the company in the last 4 quarters made $56.12 million in net income. So that's basically income that's going to the company's pockets. And so now we kind of know what the company is earning here, right? So the company is earning 56. What was it? $56.12 billion. Now this thing here, the price of the P ratio, is price per share, because that's what we have, right? We have the price per share when we're looking at a price. I mean, we could potentially get the prices of all shares, and we're going to be doing a similar thing basically, but it's going to be a little bit simpler. And so in order to adjust our calculation a little bit, and that's simple, we know that the earnings is about the earnings for everybody, right? For the whole company, for every shareholder, basically. So it reflects every shareholder. But this reflects just a unit of stock. So we could just multiply this value with all the stocks that exist, the amount of stocks that exist, or we could divide the earnings with that amount of stocks that exist, and that's probably the easier way of doing things. And in order to adjust that, we actually say EPS, which is earnings. Sorry, let's go stay with price here, divided by EPS, which is earnings per share, right? Because this price is also per share. So this is per share. So we kind of need to have a per share unit calculation, right? We cannot just go with earnings for every share and the price for just one share. That doesn't make sense. So the price, we know, it's 226.87 today. That's the current price. And obviously that changes. And we also know the earnings because we just calculated it. It was just adding all the numbers together. So it's the last quarters, last 4 quarters. So it's $56.12 billion. And now, as you can understand, the thing that we need to do is we need to divide that amount of earnings, basically the earnings that all the stocks in the company would hold, to that amount of the stock, which the amount of the stock that is actually distributed to people, basically, or organizations or institutions, for example. And this is called outstanding shares. It actually has it's called outstanding shares. It has a way of expressing it as a way of expressing this idea. And we can find the outstanding shares, I believe, here in the statistics. So let me search for it. Shares outstanding, yes. So you see that the shares outstanding here is 4.83 billion shares. So now if you go back here, we know that the outstanding shares, and actually let me rewrite it right below, make it a little bit easier. So the outstanding shares is 4.83 billion shares. That's the amount of shares. And now we know what was the net income for the whole company for every share, and we know how many shares the company has distributed so far. And so we can divide the amount of earnings to the amount of shares to find the earnings per share, right? I mean, that should be simple now. So we just divide with 4 0.83, and we get 11.61. So I'm gonna do it 11.62, and I'm going back and I'm just substituting, and that's 11.62 billion in this case. No, not billion. That's not billion. That's dollars. That's the EPS, right? It's the earnings per share. So, because the billion gets, this gets eliminated. So these two get eliminated. So we actually stay with $1. And so right now we know that the current price of the stock is $226.87, and the earnings per one share is $11.62, which means that basically if you are holding a share this year, you will be expecting to make $11.62 in net income for that one share that you own. And remember, we want to calculate the price to earnings ratio. So now it's very simple. We just do the division basically, 2.62.87 divided by 1162, the thing that I have above, and let's do that. So 226.87 divided by 11.62, and that gives us 19.52, and that's our current PE ratio. So in case you don't know what that means, it's a simple concept. I think that I basically just said like a minute ago. If I had one share that costs today $226, I would expect per year, based on the current calculations, to be getting $11.62 back in net income. That doesn't mean that I'm actually getting this money back to my pocket. This means that the company is getting that amount of money back to its pocket, and you're probably getting some dividends back. But the thing is, as the company grows and makes more revenue, this becomes more lucrative, better or worse. So you can think, for example, let's picture a scenario. So let's say that next year the Apple stock is actually 250, but the company grows itself, and now the EPS is 13. So if we calculate that, so the company is basically earning more per share. So if we calculate the new value, we will have 19.23 here. 19.23. So that's the P ratio, let's say next year. And that's a hypothetical example, obviously. But in this kind of scenario, you will notice that, and we actually call this a forward P, because this can be calculated based on projections. But this is obviously not the actual number. I'm just, I just made this up. It's just an example. But you will see that the last year PE ratio was 19.52. This year PE ratio is 19.23. So the question is, what is better? Is the 19.52 better for an investor, or the 19.23 better for an investor? If we exclude all the other elements, because there's a lot more things to take into account, the P ratio it's not the golden rule for everything, obviously. But if we just compare the two, it's generally a better idea to go with a lower one. And again, that's not necessarily the case, but because there's other issues around that, like for example, the company is making less money. For example, it could be a reason for that if the stock goes down. So it may not be necessarily correct, but if we're talking about a normalized situation like this one, we know that the P ratio is actually lower now, and this basically means that the company, the price to earnings ratio, shows that the company is a better value now because the P ratio is lower. Just because the P ratio is consisted of two things, right? The price, which is the expensive thing, and the earnings, which actually divides that price. And so more earnings would actually lower the ratio, and that's what we're looking for. A combination where the price is not that high, but the earnings are high, and so that actually brings the whole PE ratio down. And in contrast here, you notice that this situation is worse than this situation. Not by much, okay, but still. And so you kind of get an idea now, right? Hopefully, this kind of shows you how to calculate and how to remember what the P ratio is and the EPS is and how all these things are combined. So if you had a blank page right now, you would go like, okay, P ratio. Let's say that a year passed, for example, and now you don't remember anything about what the P ratio and the EPS is. You just don't remember anything about it. The only thing that you remember, because it's easy to remember and almost nobody forgets once they learn it, is that this is price to earnings. Let me go back. So yeah, I would argue that almost everybody would remember that this is price to earnings and this is earnings per share, right? And so now you're thinking it over and you're like, price to earnings. So let's actually break it down. Obviously, it's simple. The price of the stock, let's say $250, divided by earnings. And so what is earnings? Like the net income, what the company makes, not the revenue, because the revenue actually includes expenses. We're talking about the net income, obviously. And so what is the net income? It's like net income per year, right? Simple enough. And you can just calculate the last 4 quarters. That's what I did in this example. And so once you see that, you're like, okay, now we have the net income per year, but that income reflects every stock that the company holds. So we need to actually divide by the amount of stocks that the company holds. And let me actually put it in parentheses. And so eventually we will have $250, which is the price of the stock. And then we will have the EPS, the earnings per share. This is what we calculated here, right? The net income per year divided by the amount of outstanding stocks, outstanding shares, I should say. And so this will give us an amount in dollars, let's say 10. And this calculation here, in this case it's going to be 25, it's basically our P ratio. And that's what it is. And P ratios are generally used to evaluate how expensive a company is in comparison to the industry and in comparison to the other companies of the industry. And also it can serve as a comparison to see how the companies doing in the next periods and in the future periods or compared to the trailing periods, for example. Again, this may not be an exact correct picture, but it helps. And so yes, hopefully that actually gives you an idea of how to actually reconstruct the whole thing easily. Hope I explained it in plain English, although my English is not perfect, not even good, I guess. But okay, I'm trying. Don't be too harsh. And so, yeah, hopefully you will be able to just recall. If you forget it, you'll be able to just think about it as a price to earnings ratio, PE ratio. It includes the earnings per share, which you don't even have to remember. You will eventually reconstruct once you start thinking about what the price to earnings is. And so yes, you can have this as an exercise also if you like at some point. Maybe a month from now, try to calculate it on your own if you forget about it and see if you can actually recall. So yeah, thanks for watching, and let me know which kind of financial element or idea you'd like me to talk about in the next videos. I have some ideas, but I would like to get your input. So if you'd like me to talk about a specific thing, let me know, and I will try to make it as simple as possible to understand and focus on a way so that you can actually recall. Again, that's my main focus here, because you can find a lot of videos that talk about what it is, but some of them can be really, really tough to follow. So I'm trying to make it in such a way that it's actually recallable. It's easy to recall. So yeah, thanks for watching, and I'll see you soon in the next one. Bye bye.